Hey everybody, good morning. So the S&P bouncing around a little bit, trying to stage a bit of a comeback or at least find a bit of stability.
Just a reminder, everyone, of the disclaimer. So that anything we talk about today is for educational, entertainment, and information purposes only.
So how are we going to know when things are actually starting to stabilize a little bit, at least in the short term? As I've talked about, there's that light at the end of the tunnel. Technically, I think we're a little oversold in some ways. I'm going to show you some signals. Fundamentally, in the backdrop is that we're going to be quite challenged for a while. We're already seeing companies like Dick's, a bunch of retailers coming out and saying, we're lowering our forecast significantly. We have no clue what's going on. We have no clue what the impact of this economic downturn is going to be on our earnings. And I think that we can probably look forward to having a continuous stream of headlines like that for a little while until we get a little bit more clarity on what's happening on the tariff front and on the economic front. So if we look at the bearishness, we can see that the AAI bull bear is actually as low as it was in the full bear market of 2022. So from that perspective, we are seeing a little bit of peak bearishness, right? So people are getting a little bit too negative at this point, at least from a short-term technical standpoint, which leads me to believe that we could have a little bit of a bounce in store. Now, if we look at S&P percent of stocks above the 50-day moving average, we're actually nowhere near full bearish conditions, right? We've seen it as high as 90 and we've seen it as low as kind of 10 to 15. I'd say we still have a little ways to go. Quite a few stocks are still quite propped up in this market, and we've only really come off whatever it is, 8 to 9 to 10%, depending on the market, 12% for the NASDAQ. So still a little bit of room there. So a bit of mixed signals from the AAII and the percent above 50-day. One of the things that I look at is and I think everyone should look at, if you go to VIXCentral.com, you can watch the VIX futures term structure. And this is very important. So you can see where they're pricing those VIX futures. And under normal, happy conditions, this is the picture that you're going to have. So you're going to have an upward sloping volatility futures curve as things are calm in the front end and volatility rises in the back end because, of course, people are going to price in something going wrong over the long term. But the idea is that in the short term, things are calm. So this is a very normal, happy picture for the VIX futures. We see the VIX cash under here. This is the one that you see on TV, the VIX cash down in the 15s. In an unhappy situation, this is what happens. So you get this inversion, you get people panicking and buying short-term volatility, you get the VIX soaring as people buy downside protection and as the market sort of rides down that VIX curve and those implied vols that are part of those downside puts that the market moves into. So this is an unhappy picture. It can get even a little bit more unhappy and very, very inverted, but for now, that's pretty decently unhappy. So we have to keep an eye on this. What I want to see is for this to flatten, and I want it to start to head towards something more like this. Of course, it's not going to happen overnight. It can flip back to probably flat overnight, maybe even slightly in a contango, which is that happy shape I showed you earlier, with the VIX cash dropping below the futures. So once I start to see this starting to normalize a bit, which means flatten a little bit from this steep front to the next 2 or 3 futures, I still have to acknowledge that there's quite a bit of fear out there. Now, if we look at ranges, look at the ATR. That is the average true range. So when we look at measures of historical volatility, we tend to look at close to close. So what did the market close at yesterday? What did it close at today? What did it close at 5, 6 days, 10 days ago? And we measure the volatility based on that. But what about intraday? We've had big swings intraday, and the average true range will give you an idea of how wide those swings have been, as well as that close to close. So we can see that we've actually had larger daily swings than we had in August when the market fell significantly down to that 5,100 level, and we had a VIX of above 50, 65 by some measures, whether those were real or not, but we were certainly in a much more difficult volatility environment, whereas the VIX right now is only 28. So this is telling you a little bit more of the story than the VIX is right now. The VIX is kind of relatively controlled given the sell-off that we've seen. It's not low at 28, but it's relatively controlled and unpanicky compared to last September and October and August. So right now we see the fear being really dictated by this ATR. So I want you to watch this ATR and keep in mind that high volatility doesn't always mean cheap volatility. Right now, movement is very, very high. So options are actually not that expensive because remember, they are a relative value product. High options versus even higher movement, it means that they're relatively fairly priced or even underpriced. So there's a lot of movement out there. So options are not that overpriced right now. But having said that, we are quite high versus the average VIX of say 19.5, and we VIX tends to be mean reverting. So at some point this market will sort things out and we'll get the VIX back under 20. But for right now, we can see that movement is way too high. So you have to be very, very careful with your option selling programs because what you're doing is essentially just selling insurance. You want to make sure you're not selling that house insurance into a worsening storm. So what do I mean by worsening? Well, right now it's pointing straight up. This ATR is straight up. I want to see this start to relax, maybe flatten a little bit, and even start to come down. If I start to see this come down and I start to see this VIX curve start to normalize and the VIX cash come down, I'm going to be much, much happier and more constructive on being short vol and a little bit long equities. Here's your 9-day VIX. So you can chart this on stock charts, VXST. 9-day VIX is going to reflect very, very short-term fear levels. And we can see we're actually getting close to those highs of December, which were about 35. So we're getting a little extended from this perspective. And another thing I'd like to look at is the VIX 9-day versus the VIX. Tends to, when that ratio gets to 120 to 125, that tends to be a sign of washing out to the downside in equities and maybe a sign of a potential bottom, perhaps durable, but perhaps just short-term bottom. So I would watch this to start to keel over. I would watch that VIX curve to start to flatten and normalize and that VIX cash to come down. And I would look for this ATR to start to simmer a little bit because right now it's just pointing straight up and that's a difficult condition for equity markets right now. So hopefully that helps you guys and gives you an idea of what I'm looking for, and we'll see you in the next video.